Great. Want to give a quick intro about SVB. We are the financial partner of choice for the innovation economy. Fun fact, over 80% of IPO companies in the US have banked with us. We sit strategically between founders and VCs, which gives us a lot of great opportunities to work with amazing people like Ellie and meet amazing founders like you guys and really create a very healthy cross-pollinating collaborative ecosystem, especially when it comes to fundraising for early stage founders. A little bit about myself. I was an operator investor for about a decade in consumer product and Web 2.0, and moved over to the investing side at Samsung Next, the CVC fund. And now I lead our founder success team, helping amazing founders like you with fundraising, company building, and larger connectivity to the tech ecosystem. And also want to pass it over to you, Marissa, to introduce yourself.
Hi, everyone. I'm Marissa. Thank you so much for coming in. And for those of you tuning in, so I am a senior associate on our startup banking team. I partner with Bo on our founder success initiatives, and then I also lead our business development and strategy efforts here as well.
Great. And I would love to welcome our speaker, Ellie Wheeler, today. She is a partner at Greycroft for over a decade, leading the digital health team across consumer enterprise models. Previously, she worked at Lowercase Capital with Chris Sacca and also led corp dev at Cisco in acquisition investment strategy. Ellie began her career in growth capital P firm at Summer Partners in Boston, and she holds a BS in psychology, graduating magna cum laude from Georgetown with an MBA from Harvard. So we're super stoked to have you today. You've got a tremendous investing track record and a lot of star portfolio companies. So very eager to get your insights on the ground about what's happening in the larger macro landscape and fundraising. So the kind of whys behind why you're here, we really want to set the ground for you to think about, fundraising is a very introspective process. Like, why are you uniquely positioned to tackle this at this time? Why now? Strike while the iron is hot with the problem that you're setting out to solve. And lastly, why this problem? So we're going to kind of take you step by step tactically, but also kind of set the larger macro picture for you guys to really think about what is the best strategy and position to kind of hit the ground running when it comes to fundraising in 2022 and very soon Q1 2023. So just, quick housekeeping. Obviously, fundraising is very bespoke. A lot of this is going to be personalizing it to your strengths. Also, it's a very relationship-based process too. A lot of the data that we're sharing today is going to be New York specific. We're pulling macro data, from our own proprietary data sets, but also from PitchBook. So it will differ per region if you're, fundraising outside of New York or in different country. And most of the data is going to be reflecting what we've collected from 2020 to 2022. So obviously, a lot has happened in the last 6 months. We'll probably, share some of insights, but Q2, Q3 of this year, we're still harvesting that data. So to kind of set the tone for you today on what is happening in the last 6 months, since March, it's been very hectic. And the top 3 charts here kind of shows, where the economy is. And so much of the Fed's job is to keep interest rates low as well as unemployment low. And we've kind of been hit by this trifecta of supply chain issues in Ukraine, disrupting, energy, oil supply, as well as China's COVID zero policy, coupled with climate change, drought and flooding. That's kind of created this, seismic shift, as well as with a larger inflation rates that have hit since COVID, so much of what we're kind of going into is like the interest rates have increased, which impacts public markets, locks up a lot of capital there. But also we're continuing to see federal fund rates increase through Q1 of 2023. So how does that impact you guys? Well, in 2021, we saw over 70 IPOs happen. In 2022, we're only seeing 3. So the public markets have definitely, frozen in a lot of ways. And there is, since 2008 with the great financial crisis, correlation between what the public markets and the private markets have looked at, with some time delay. But the good news is we still have record dry powder, for 2022 and beyond. It's just a lot of VCs right now, and very curious to get your take, Ellie, are still in this kind of observational mode of where is the market going, delaying, certain deployment of funds until, the economy stabilizes and also pricing stabilizes. So this is just kind of setting the tone for what we're going to open up some more data around. In terms of dry powder, we wanted to kind of show you how much funds are being deployed over time, by the different life stages. There's early stage all the way to growth stage. And I want to highlight some data from Preqin, which is a data provider we pull about, there's been a pop in 2021 around mega seed funds. A lot of multi-stage firms like Tiger, Cotu, even Bessemer raised, their largest seed fund of all times, which kind of makes them the 9th largest seed fund. So even though there is, certain slowdown in terms of deployment of funds, there's still a lot to unlock, especially in fundraising in Q1 of 2023. And I'm going to pass it over to Marissa, since Ellie specializes in healthcare. We'll do a quick deep dive around the healthcare landscape.
Yeah, so this chart really just shows over the last decade how there's been a significant increase in the amount of venture funding going directly into the healthcare space. I think when we talk about healthcare, some things that can be kind of convoluted, especially over the past decade, are what is true life sciences, digital health, versus there's a lot of consumer health and wellness as well. Here we're speaking more strictly to digital health and the life sciences sector. And as you'll see, 2020 with COVID really accelerated this push into 2021, where we saw record high numbers for the investment in the digital health sector. This first half of 2022, we did see a dip, and we're waiting on final numbers for the year. But I think just showing that over the first half of 2022, we were just $1 billion. We were at 15.8 billion, whereas at 2020, for the whole year, it was 16.8 billion. Just shows how there continues to be a push in this direction. And while we went over inflation and all the different market changes, the healthcare sector does seem to be less affected than the general tech markets by some of these shifts. So that's something we're noticing as well. And then CD Insights just recently put out their digital health market map for 2022. So here you'll see just all the different areas within healthcare where there's a lot of investments that are continuing to pop up. So things like care coordination, home health and wellness, digital therapeutics, hybrid care. These are all areas that investors are finding to be interesting and that companies are building in. With that, Ellie, would love if you would maybe share some of your perspectives on some of these subcategories and what you've been most interested in recently.
Sure. Well, I guess I have some comments on the stuff before, but we can start here. We take a much broader view, I think, probably of healthcare than as the way as you're defining it. We don't touch life sciences or molecules, but things that are on the consumer side, we include. So we're looking at things that are consumer business models, fintech business models, enterprise business models, as you'd expect, because it's a sector, not a business model. And then obviously just taking a step back, Greycroft, seed to growth venture fund, New York and LA, out of our early stage fund, we're investing, 1 to 15. It's mostly seed and series A. Out of our growth fund, that's going to be to accelerate something that's working. It's going to be a check size of about 15 to 40. So we are looking full life cycle, and there's 4 sectors where we spend time: digital health, which again, broad definition, fintech, enterprise software, and consumer internet. So we're seeing a lot of these trends really kind of across sectors and across markets. I think your point on healthcare being less impacted is kind of true. Yeah, it's true that people get sick no matter what the economy is doing. But if you've taken a look at the public performance, you can see that it is certainly as impacted, if not more so, than some of the other sectors, particularly in the recent past. Granted, some of it is a correction from it just being overheated during the COVID period. I think just what we're seeing generally is that the aberration was 2020 and 2021. So it's almost like throw away all the lessons that were learned in those 2 years, because those were the aberrations. We can start looking over 2019, which was kind of the year, the before times year. You know, and we're even starting to see that in some of the data that's being released. It's like, okay, well, we're looking at Q3 2020 and the most recent quarter that's showing similarities to that, as was in some data that Cooley put out this morning, was Q4 2019, right? Like, you know, so it's all starting to make sense again in some ways. And I think kind of the aberration was those last 2 years. In terms of where we're excited, we're thinking, just as like venture mindset, right? We're thinking decade-long trends, right? The things that we're investing in today are hopefully the public companies of 10 years from now. So, we're not, yes, you have to stay alive to get there. So there's some upstream financing that, needs to happen, quite a bit of it. So every, 12 to 18, 24 months, you're going to have to show progress and milestones. But in terms of the areas that we're excited about and the trends that we're investing behind, it's really, much longer term view. And we're still really bullish on that, right? In terms of we're very early in the digital transformation within healthcare. So much is still done via fax. And obviously, just as consumers navigating the system, how little anyone talks to each other. And, you think about using a consumer service and there's certain expectations that you have, and you have to throw those out the window once you start touching your own healthcare because the experience is so convoluted. So there's a ton of opportunity in terms of how technology can transform that. So, some of the areas that we're excited about now are certainly some of the fintech models that are coming to healthcare. That's not new. Revenue cycle management is part of how the system works. But we're seeing a lot of innovative models, keeping the consumer top of mind, as well as thinking about how to make a provider business model work. Selling provider to provider, pretty tough. But we are seeing some fresh approaches there as an area where we're continuing to spend time. Spending a lot of time on Yvonne, next generation data interoperability. And we've got some early winners that have been able to extract decent data sets out of EMRs, EHRs, which is enabling what we think is going to be a wave of applications that can be built on top of that. So it's an awful lot of time and burn to try and assemble those data sets yourself. So if those exist, I think there's some pretty interesting opportunities for companies to build on top of those and really, kind of take us forward. It's kind of how some of the enterprise markets have evolved. Healthcare just tends to be a little slower. And then we still do look at care delivery and some kind of next gen models. We think that wave 2, well, let's say wave 1 was kind of channel switching. So taking something from offline and moving it online, and then saying, this is going to be more convenient and hopefully it's going to increase access and maybe we'll do something about cost. I'm not sure that actually proved out to be true. It seems like cost was just spread around. So I think the next wave, the bar's higher. There needs to be a reason for you to exist digitally. What are you going to be able to do that's different because you happen to be virtual first? So is it a different care model? Is it a different way of thinking about things? How are you going to drive outcomes and cost in a way that is unique, that gives you kind of a reason to exist and be able to carve out a big chunk of the market? So you're kind of taking a different view on that, caring a lot about ultimate gross margin, what that can look like, high spend categories with quick time to value. Because again, oddity of the system, you don't get paid for prevention. So if you can show me ROI in 3 years, you're just not going to get paid. You need to be able to show progress, in the short term. And then, a bunch of other things we're excited about too, but I could just go on all day, so we can keep going.
That was great. Thank you very much.
Great. Very curious to get your take on this too, Ellie, since you joined Greycroft right after the great financial crisis in 2011. We wanted to kind of show you guys how the current state of the economic downturn could benchmark with the great financial crisis back in 2018, as well as the previous one with the dot-com boom. We're definitely seeing more of a drop in Series A deals and less so in seed in 2022. That has also notably due to the fact that there were some very mega, there were mega seed deals that were closed in the past year. There were two $100+ million seed deals, including, the Bored Ape Yacht Club, et cetera. So there is some, deviation of what a normal seed has traditionally looked like in the past year. But also, this kind of highlights the degree to which we're seeing pullback happen in fundraising currently is not to the magnitude that the previous financial crisis, you can see in the green line to the left hand chart, and the dot-com boom. So fundraising has not gone to zero, and there's still a lot of dry powder out there for folks to go after in fundraising. But I would love to hear, Ellie, starting out as Fund One partner at Greycroft in 2011. What was the kind of zeitgeist joining, and how have you guys kind of equipped yourself to think about the current downturn?
Yeah, it was fun too when I joined in 2011, our first institutional fund. I just think it's wildly different. They all are, right? But I guess the point is we've all, most of us have been around long enough to have seen cycles, and a lot of people in the ecosystem haven't, and that's okay. It's not good or bad. It's just, that's what happens when there hasn't been one in a while. And I think, they tend to last longer than people think they're going to, in a nutshell. And no one's particularly good at predicting them, or we'd all be doing something different. But, the founders in our portfolio who've kind of been there before were the first ones to react, and they reacted the most dramatically. And that all makes sense. And then, others who were, kind of learning on the fly, or, were a little bit slower to react and often didn't react as fully. And, it hurts to have to do something more than once, particularly if you're talking about a layoff or something that's going to have far-reaching implications, both culturally and other things. I think that, we're still early days in whatever it is that we're in. I think the next year we're going to see, you're just starting to see more of the corporates pull back spend, freeze hiring. We haven't seen layoffs in the way that you would expect quite yet. So, I think it remains to be seen.
Great. And a little bit more funding data around New York specifically. So New York tends to follow the national trend. We definitely saw 3 out of the 12 mega seed funds I referenced gain funding in 2021. Trust Machine Power, Contractor, a construction company. So just to kind of highlight, the median data here is not shown. It's more the collective amount of fundraising, amount that was achieved. Definitely Series A has more of a fall off, given more connection to later stage and public markets, kind of locking up. And then when it comes to valuation, you can see the median value for New York seed deals has gone up in 2021 to 2022. A good chunk of this data, I will qualify, is from Q1. So before a lot of the headwinds kind of hit. So we're very curious to see what the Q2, Q3 data will be. One thing to also highlight is, even though it's, these graphs are showing valuation has gone up in 2022, we're also getting some reporting bias where you don't get data around down rounds, around extensions. Like, people aren't going to TechCrunch, saying my valuation stayed the same, but I got an extension. So I think, a lot of what is going to be interesting is going to be the end of the year reporting and seeing where Q2, Q3 led us, especially since headwinds were way heavier. I would love to kind of get the Greycroft take on valuations and pricing. This has been a huge topic for a lot of our founders who are fundraising, is how much of a valuation slash should you be expecting? And, you know, when survival is paramount to growth, you know, should you just take what you get instead of negotiating? So curious to see kind of the fun dynamics between founders and investors here, and how Greycroft is thinking about that.
Yeah, I will absolutely answer that, but also some of the Q3 stuff came out today.
Okay, great.
And that's kind of what I was referencing. So Q3 2022, I mean, it's down by half, even from
Wow.
Q2, just in the amount of both the number and the dollars. So it's starting to show up as you might expect. And then we also got a piece of data today about down rounds represented 11% of Series B and later financings, up from 7% in Q2 and 2% in Q1. And so that's pretty meaningful, seeing that already come through, especially when so many haven't had to come back to market to actually see that happen. So it's starting. But your question was about take the medicine and the money or don't. I think that maybe it's a self-serving answer, but is it? Because if we're sitting at early stage, this is happening to our companies, growth stage too, you don't have a choice unless you have some magical other option, which perhaps you do. But like what I said before, I believe fully, I mean, 2020 and 2021 were the aberration. And there are a lot of funny money numbers being handed around. And that's what wasn't real. And there's a pretty dramatic re-anchoring that has to happen. That's really hard to do. I recognize that. It's a pretty extreme re-anchoring on the part of that number that we had just is irrelevant. And now we have to see what the number is. But I do think that's kind of the right way to go out to market and the right way to think about it. Because ultimately, as founders too, you know, you're thinking about the end goal, the ultimate outcome. And there's going to be a lot of short-term blips, if you will, over the next year or two as these things work their way through the system. Right. So one of the metrics that we're talking about with companies is actually, you know, well, how much capital do you have to grow into your valuation? Right. That's another way of saying the same, which is like how much runway you have until you have to actually raise. Because framing it that way, well, as multiples have shifted pretty dramatically, in some cases, the answer to that is going to be huge. Right. At the rate that you're growing with multiples as they are, without assuming that there's going to be something dramatic that happens in terms of multiples, you might need 6 years to grow into it. Well, then, you know, that's probably not going to happen. You probably don't have 6 years of runway. So something's probably going to reset, or you're going to have to think more flexibly about how you get between point A and point B. That's not to say that everything that happens in 2023 is going to be a down round. Of course not. But, you know, there's a lot of notes out there with caps that were previously thought of as being priced. Well, you're going to find out that they aren't, right? Like there's going to be a lot of that stuff that's going to shift. And, you know, goal number one is to live to fight another day, right? And continue to grow value in business. So I wouldn't get overly caught up in it. I know it's super hard, especially as you have to eventually explain to your employees why things are different and their 409A price is changing and all of that. But, you know, a lot of stuff happened over these past few years that probably isn't going to hold up.
Great.
There's an echo, I think. Is this any better?
Can you guys hear us?
Okay.
Yes, that's
Seems
better.
better.
Okay, great. So obviously lots of variables to kind of think about, but we do want to leave on a more optimistic note is just a reminder that some of the best innovation in, tech has come out of strife and downturns. The GDP of tech has increased steadily since 2000. We've seen a lot of boom come out of the first.com, working in social, web 2.0, the mobile apps, as well as the great financial crisis was a catalyst for a lot of sharing economies like Uber, Airbnb, and COVID, even though, to Ellie's point, which is incredibly valid, it was a huge aberration in terms of how the markets function. It also created a crisis that asked us to really necessitate thinking about workplace collaboration, digital health, mental health. So out of all these moments of crises, there's an opportunity here. And I think that's what's really powerful about this crowd, is just you guys are opportunists who see moments and know that there are problems that need to be solved. So cool. So we're going to kind of kick off into more of the tactical portion of the fundraising workshop, is just really starting out with a lot of these, a priori questions before you hit the ground running. Is just, what round are you raising and why? How is this the best time? Is it now? Is it in 3 to 6 months? How do you think about getting that first intro, that first meeting? And also the deck composition, what is the content that's going to drive the VC to a first meeting? This is one of our hallmark slides because it really kind of breaks down the different life stages of rounds between pre-seed, seed, and Series A. Obviously, if you've been in venture in tech for more than 5 years, the past decade has really shuffled a lot of the early stage, terms into what would have been considered a late stage term. A pre-seed is kind of a seed, and a seed is a Series A now compared to 5 years ago. But there are kind of characteristics, universal characteristics that we can look at for what is a pre-seed. Typically, that's going to be anything from an idea on a napkin sketch to mocks to prototypes. It's pre-product. 90%, of that decision is going to be heavily indexed on the founding team, their track record. Typically that round is going to be unpriced. It's going to be full of angels, individuals, maybe some checks from non-institutional VCs, and dilution is going to be pretty low. So less than 10% to 20% max. At the seed stage, the expectations do increase in terms of showing some traction. Is it about, the product is in beta, you got a wait list of 100K, you're starting to court a mix of, angels, individuals, but also institutionals, and that round can either be a unpriced or a convertible note. Dilution does kind of increase a little bit more, and at the Series A, this is kind of where the big, you are starting to adult and grow up life stage of the company. The product is showing some product market fit. You are starting to see network effects and scaling. There's, traction in terms of you find the ideal customer profile. And at that point, that's when the institutional lead starts to come in, and it's going to be a priced round. You might be having conversations about giving up a board seat, and dilution will be north of 20%. But obviously this is a very generalist take. So I'm curious, Ellie, in healthcare, there's a lot of R&D, a lot of CapEx that goes into these companies. Like, are you seeing the breakdown between pre-seed and seed differently than, say, consumer enterprise software?
Yeah. I'm sure that's true in life sciences. I don't touch it.
Okay.
So we don't really have kind of R&D, and I guess there's CapEx if you have a hybrid solution, but what does happen is things take longer. So the rounds oftentimes are bigger, not always. Again, these are rule of thumb. A lot of it can vary. And there's a certain amount of, it's a little bit ideal to be able to say, okay, we're going to do this, and then we're going to raise this round from this type of investor. And it happens that way for maybe 4% of companies. most just get what they can get together and move on. So like, that's okay if that's what your system and then that's what your process is. That's more normal than you think. It's but it's hard to put that on a slide, right? This stuff has been so fluid the last few years. I have no idea what's called what. And you know, it's the way that we really think about it is, okay, are you raising enough money to be able to reasonably show progress, right? Like what are, you almost work backwards, like what are the milestones that you're trying to prove out over the next X number of months? And, you know, how much capital do you need to reasonably be able to do that? And in healthcare, that answer might be a little bit longer than a product-led growth SaaS company. Just because things tend to take a little bit longer, and you also can't launch with an MVP when you're dealing with people's health. Like there's just some different, fintech shows some similarities too, just a more regulated industry. There's different considerations. You can really screw it up if you don't get the regulatory stuff right and the licensing and compliance in the early days. So there's a little bit higher cost to get started. So really it's more like, what are you trying to accomplish? What are you trying to prove? Is it reasonable in the timeline that you have to be able to do that? And then you can kind of fall into what the minimum number needs to be. But that's something that we are thinking about, and whatever round this falls in is, you know, is this amount of capital that we're talking about actually going to be able to get us to, you know, kind of drive enough value over the next 18 months, which is similar, right? How are you getting to those next set of milestones in order to unlock that next round or whatever comes next?
I think that brings up a really important point, which is looking at fundraising to achieve the milestones, because I think sometimes, especially in these past 2 years with the amount of hype that's been around just venture fundraising, we're seeing the fundraising as the milestone itself, which is something for companies to definitely celebrate. But like with that funding comes expectation. So I think shifting that focus into the mindset you mentioned is really helpful.
Yeah. Great. So in terms of really thinking about when to start, picking the right time to raise, you know, is crucial. Obviously, we're heading into the holiday season, so probably a good thing to not start hitting your investors now. But we've also seen a shift, you know, from the kind of COVID, like everything is done online fundraising, to now coming back to in real life meetings, coffee chat. So the kind of seasonality of fundraising is still, you know, kind of avoiding obviously the summer months, since partners tend to go on vacation, as well as the winter holidays. But we're definitely seeing a return to kind of the normalcy of fundraising during a seasonality. In terms of qualifying who should be on your investor hit list, you know, this is to Andrew's point, you know, he worked at enterprise SaaS. Like a lot of this is really a numbers game, and having a clear kind of VC hit list in order of operation for you to experiment, iterate, and really take that learning while these mistakes are cheap. So like qualifying investors based off of what they invest in, but also thinking about like, who do you want to do those practice runs with as like a dress rehearsal? You know, talking to an individual angel is probably safer bet than, you know, talking to an Ellie in like the first 3 conversations. So really kind of building up those cycles of rinse and repeat is really important as you kind of work down your order of, you know, least important to most important VCs to hit up. And the piece about qualifying really is crucial, because not all investors are equal, and showing that you've done the upfront research, right? Knowing that Ellie doesn't invest in life sciences, but, you know, digital health and like enterprise models, like that is really key to locking the first conversation. Understanding the check size, like it's okay to ask, do you lead or do you not lead? Thinking about the vintage, which is a more nuanced factor of like, when did you close this current fund that you're deploying out of? Was it 6 months ago. So there's a lot of dry powder and there's probably a more urgency and speed of velocity investing. Was it 2 years ago and you're more at the tail end? And also, honestly, thinking about who your competitors are. A lot of first-time founders we've noticed think, oh, because XYZ founder invested in the same space and product as I'm building, then they must be a natural fit. Well, actually, you know, if you think about how VCs think about it, they want an even spread of bets. So they're not going to keep betting in the same space, the same problem. So really doing your research, making sure that you're not wasting these VCs' time too, with information that's already available on the internet. Starting to find a lead. I think this is kind of the fulcrum to how you close around, and it is honestly the hardest point, where you spend most of your time trying to create this tipping point effect, where you talk to a bunch of investors who may show interest, you talk to angels, but really having kind of that like 80-20 Pareto rule of like, where the most work you get out of it is probably from doing the most strategic work, which is locking in your lead investor. And that's going to come from, you know, understanding like what all the previous conversations are teaching you about how to raise this round, understanding, you know, that like the current check size you might be going for maybe either too big or too small. And it's okay for you to really be explicit about landing that lead. And you also want to be showing some degree of traction in the round. Like, do you have 30% closed, 40% closed? Is there some type of urgency and FOMO effect? And with that, I'm curious, like Ellie, like, do you have any tactical strategies for early stage founders who are kind of like doing the slog of talking to a million people, but they're like, I get a lot of individual interest, but like, how do I get that anchor check, which is, you know, the most elusive, but then once you get it, everybody wants to get in.
Yeah, that's a tricky one, because the answer is it just depends, right? First and foremost, it only takes one, right? Only takes one, yes. What we saw, particularly if it's a smaller round of pre-seed, you can get a smaller investor to, you know, kind of set the terms with you in a note, and then you kind of round up the interest that you do have to be able to close on something just to get going. That's a less viable as you get to you know, trying to do a $4 million seed round or a Series A. But in the early days, you can try to do that. It doesn't really work to go to a lead investor and say, here are the terms of my round. We do see that happen, and it's just a little bit, it's not what people are expecting, because the lead investor is expecting to set the terms of the round. So typically, you know, you just want to be a little bit more non-committal, right? In that you're going to see what the market bears in terms of the terms that you're looking for, but the range of investment that you're looking for is, you know, 2 to 4 million based on the milestones that you're expecting to hit, right? Like, there needs to be a reason for what it is that you're asking for. I think a lot of what was said is right. You know, you need to understand, are they a lead investor or are they not? So are you even kind of making the right assumptions around what they can and cannot do? It's decently easy for people to show you a lot of interest and excitement and just want to kind of hang around and see if you get a lead that they're interested in. Put those people on the back burner and don't believe that it's real. It's only going to be real if it's a handful of people that they're excited to follow. And then the reality of that is, once you have one of those people that they'd be excited to follow, you don't need them, because your round there'll be plenty of people who want that. So they're not the most useful. It can be, particularly if they've got a perspective on your space or access to a unique network. It's not like non-lead investors aren't helpful. They can be extremely helpful. But in terms of your time allocation and even mentally what you think you have spoken for in the round, I'd be very conservative in what you think that bucket will bring, because that is contingent capital. And it is free for them to say very positive, excited things. It does not mean that they are going to write you a check. right? Like it's really more of a, if you're them and you want to leave the option open, how do you do that? You're extremely effusive. Just in case, because you just don't know, right? Like, so you've got to be a little bit skeptical until the money's in the bank, right? That's it isn't over until people have wired. Particularly in this market environment, honestly, because it's a little bit trickier. But yeah, lead investor can get things going, but gotta get scrappy at a certain point if that doesn't seem like it's gonna come together.
Yeah, I think it's very
We need
wise.
psychology with Ellie Wheeler.
Yeah,
Style.
there is.
Scientists.
Yeah,
Psychology.
It's really hard, right? And founders can, you're trying to herd cats, right? And you probably have an ideal timeline in your mind. And I know everyone tries to get everyone moving at the same time. And in your mind, you've got this ideal 3-week process that you're going to run. And that's great to have that goal. But it might not work out that way. And it can be, you can end up making it more difficult for yourself by putting things in such tight windows. Because then you're telling that bucket of follow-on investors that you're going to have this wrapped by January 13th. Right. It's like, that sounds like a great day. And then you call them up on March 1st and say, hey, we've got it wrapped. Well, they have already written you off, right? Like they've moved on. They've seen 6 things more than that, way more than that since then. Right. So it's these things are hard to juggle and manage and try and keep everyone on the same timelines. And I know why you want to do that. But at a certain point, you got to work with what you've got.
Ellie, a question I have for you, because we've gotten mixed answers from VCs that we've had in. If you pass on a round with a founder, one, do you think it's appropriate for the founder to ask you who you would recommend them speaking to in terms of other investors? And what are your thoughts on them coming to you for future rounds?
Recommend, yes. Ask me for intros, no. And I'll say no to doing them because it's a bad look for you, right? I can't send an intro to another investor and say, hey, you should really meet this team. Because the first thing they're going to ask me is, oh, so are you investing? And then I'm going to say no. And there's just like no scenario in which that's a good look for the founder. So it doesn't make sense for me to do, and it doesn't make sense for you to want. Recommend, sure, I can give you like, this isn't for me for whatever reason, but these are the types of people that might be interested in what you're doing. There's very rare exceptions. Maybe if I've invested in something that's directly competitive and I've known you for a long time, that could be different. I'm trying to come up with a scenario in which maybe it would be okay. So recommend, sure. Intro, no. Future rounds, absolutely, because we are kind of a life cycle investor. Now there are times where that doesn't make sense, because it's just not an area we invest in, right? But if it is an area we invest in, then certainly we want to know as things go forward, but it's also on us to kind of maintain a relationship as well.
Thank you.
all right. So kind of speaking of what you were saying, finding the true believers here and not wasting your time. I think angels are very underestimated as people who can kind of use their network, social currency, and expertise to kind of help unlock the pathway to finding a lead investor. I started out as an angel investor and really saw how these small checks can really compound in terms of like how much they can do for you. So obviously angels aren't going to be leading rounds, but if you tap into kind of the network effects of angel investors, there are pretty well-known groups like Backbone Angels, the Shopify Executive Board. They do a lot of angel investing as well as #angels, the women execs who exited from Twitter's IPO. Like there are still networks for you to really dive into, where I think the ROI for these small checks is actually quite high, because you might be getting hands-on investors who help you with product market fit, with go-to-market strategy, with partnerships, et cetera, based off of their operating expertise. And then going to what Marissa was saying, like not all intros are going to be equal here, like having the strength of signal is such a key function to landing these great intros, having someone who can vouch for you, whether that be a VC or a founder. The founder whisper network is incredibly powerful because so much of what these VCs are hearing on the ground kind of previews like what your first meeting is going to be. So if you have, 5 different founder friends triangulating with a couple of firms that you really want to go after, that's a much higher signal than, if Ellie passes you and then sends that deal over, that's more of a negative signal because she can't vouch for you. So really thinking about the strength of these, signals, as well as how many of these signals are coming from in terms of influence. There is a psychology of fundraising, as Andrew mentioned, crafting that kind of FOMO / urgency momentum takes a village of people who really can bet on you, and don't understand the power of a cold outreach. Like the quality of this cold outreach is such a high determining factor, because if you have done the research and you've personalized that note and you showed that you read, XYZ blog posts and thesis, and you've really been thoughtful about it, like that could actually be a compelling reason for someone to get back to you. So this is just kind of a quick note on the spectrum. And then in terms of prepping for that first VC meeting, obviously there's a lot of different, content collateral, but the standard one pager kind of pitch deck is kind of the catalyst for what you want to be sending as a preview of the company. Understanding the investor's kind of strike zone, focus area, thesis is also going to optimize how specific you want to be tailoring your email and content. And pitch deck, you could have different iterations, versions of what that pitch deck looks like, depending on the VC firm. And, the NDA is something you really don't need to broach at this stage. It's just quite too early, especially since, there's a lot of competitors who are building in the same space. Like VCs want to be keeping their options open. And lastly, understand that every single fund is going to be bespoke and unique, and like think about crafting the right questions that you want to be asking in this two-way conversation.
Just to make a quick point though on the FOMO conversation, it's really important just to remember that investors all talk to each other too. So like in those conversations, not being like, oh, well, if you pass, this fund is like going to lead, like obviously staying truthful, but just keeping that in mind, because investors will look to each other for signals.
Yeah, absolutely. I do think and I think Ellie touched upon this too, is like the FOMO has to be real. It can't just be like you engineered it yourself as a social engineer, like it has to be like, oh, we have competing term sheets, we have competing lead investor conversations that you can reference, because VCs, small world, like they all talk to each other. Ellie could be going to a happy hour or a holiday party and talking to Dina at Lux, and they're looking at the same deal, right? So I do think there is that kind of the iron has to be hot for you to strike it. You can't just do this single-handedly. And in terms of the deck composition, these are kind of like the 6 different aspects of what you want to be showing. We do have more examples of pitch decks if you guys want to kind of work with us as clients too. So there's a pitch deck library we can reference. This kind of goes back to how to think about the no. You're going to get a lot of no's. Not all no's are going to be equal. You might just be getting some like, hey, you're too early to preserve the company's optionality. You might be able to push back and really understand and decouple that. I'm curious, Ellie, in terms of like a soft no versus hard no, like what is your own personal style in terms of giving feedback to founders that might be too early, might not be the right fit, or just,
again, this is not a non-answer, but it kind of depends. which sounds like a non-answer. It's, if you've been on this side of the table long enough and you've probably given explicit feedback and gotten that email back that's 5 paragraphs long about how wrong you are, which is fine, because yeah, you're right, we're wrong all the time. But when that happens enough, it's easier for investors to just wave their hands and say, this just isn't for me right now. And so kind of there's reasons people give soft no's, and some of it is because you end up in back and forth that aren't particularly productive. Some of it is, gosh, it just isn't one of the 2 things I'm going to do this year, right? It might be an interesting company in an area that I'm excited about, but if I only have so many slots this year, it just might not be one of them. And that is a little bit hard to convey. But if that's true, it means we've probably progressed far enough in diligence that we're having a real conversation about why we're passing. So you're going to get more depth of feedback if you progress in a process. If you've had one call and somebody passes, it's probably just going to be pretty perfunctory. It kind of depends. But it's like I guess the other way of saying what I was getting at is there isn't a lot of upside for investors to give you hard feedback off of 1 or 2 pitches. It's, just like game theory wise, right? The odds, like what's in it? Why would I, after a seed pitch, say, I don't think you're a founder who's going to be able to take this to IPO? There's 0 reason for me to do that. So, there's a certain reality to it as well. In that the incentive isn't there if you're not deep enough, and you kind of want to preserve, especially if you're a life cycle investor, maybe you're going to do something amazing. Well, you want to have handled it in such a way that you're still going to want to come back and talk to you later. So, if you end up with a lot of amorphous feedback, it can be worth finding the person that you think you have connected with the most to call them up and see if there's something else there, and figure out if it's a market concern, if it's a business model concern, if you weren't telling the story in a way that's resonating, because there can be something there, but it kind of will take you digging in a little to see if you can get it, and they might be wrong. So there's that too.
That's super wise. I do think that the point you make about preserving optionality is like so key to a lot of investor psychology. So like knowing how to unpack the no is incredibly critical.
I guess the one other thing I'll say is you can get really good feedback during fundraising if you're open to it, right? In terms of like, hey, we just don't believe ACVs in this sector. So what we're really going to be looking for the next round is showing that land and expand is real, right? And if you hear that consistently, well, that's interesting. You've just really kind of uncovered their concern, which is that ultimately you're going to need a huge amount of market penetration to be able to be a $100-200 million revenue business, because they don't think that the ACVs are there. Right, like there are things that can be really valuable. It's just kind of getting a feel for what's noise and what's
great. And to kind of wrap up the workshop, we wanted to give you an overview of what are the different ways we can continue working together with SVB and you guys. So as a client, you're going to be able to unlock resources like Marissa and I. Our founder success team works on a lot of pitch deck reviews, really thinking about the fundraising strategy and approach for our clients. We're also going to be sending out a one-to-one Orbit invite, which is a peer-to-peer learning tool that allows you to answer a series of questions and will match you to another founder of a similar life stage and sector. So you can kind of find a, fundraising buddy to really chat with. And then, the last piece is just as you start to think about your own fundraising approach and how you want to be putting together a pitch deck, we're here as a resource for you and really creating that kind of two-sided market between VCs and founders. So thank you so much, Ellie, for joining us today and sharing us deep insights around healthcare and the story of Greycroft. If you guys, want to kind of continue the conversation with us, Marissa and I are happy to kind of chat one-on-one and share more about working with SVB Startup Banking Team. Thank you so much.
Thank you, everyone.
Take care.